Hello, I'm Mark Wilson. I'm CEO of Aviva. Now, it's probably an understatement to say that 2016 was a year of a lot of upheaval, particularly political. But you know, when it comes to Aviva, our results were simple and clear-cut. It was about more operating profit, more cash, more capital, more dividend, and you know, more to come. But I want to let the numbers today speak for themselves, but let's look at a few of them. So first of all, operating profit. Operating profit is up 12%. 12% to a little over £3 billion. Now that's ahead of consensus, and I might add it's the fourth consecutive year we've grown operating profit. EPS, earnings per share, that's also up. That's well ahead of consensus. That's 3% up, and that's despite the dilution from the Friends Life transaction. Now the balance sheet's important. Everyone focuses on the balance sheet, and rightly so. And I think we've gone from having a relatively weak balance sheet to certainly, I would suggest, one of the strongest around. Our balance sheet, the Solvency II capital, that's up to 189%. And when you consider our working range is only 150 to 180%, yeah, I'd accept we're well outside our working range. Now we've signalled this before. We thought we were going to get here, and I know we've got excess capital. So the real question is, what are we going to do with it? Well, we're going to do a few things. We're going to continue to invest in our high quality franchises. That's one. Secondly, we're actively planning for a return of capital to investors in 2017. And thirdly, we've got some expensive debt out there, and we're going to pay that down as well, use some of our excess capital for that. That's all good for the business. It's all in our toolkit, and we're going to use it this year. And then of course there's a dividend, a lot of focus on the dividend, and rightly so. The dividend is up 12% to 23.3 pence per share. Now our investors know we have a target payout ratio. We want to increase that to 50% by the end of this year. And so we're partway through that range as well. So very good progress indeed in the dividend. But at the end of the day, we're there for our customers. We have 33 million customers, about 16 million here in the UK. And in the last 12 months, we paid out £34.4 billion in claims and benefits. And what about our businesses? We operate in a number of different business lines in different geographies around the world. And in our key businesses, we've seen some pretty solid growth. Of course, we've got life insurance, general insurance, health insurance, asset management, and all of these numbers are again going in the right direction. This is really a benefit of our diversity, and our diversity means we can get consistent growing results despite uncertainty in a number of markets or changes around the world. So let's look at general insurance. Net written premiums are up 15%. That's our best growth in 11 years. The operating profit for general insurance is up 17%. That's a pretty solid result as well. Some of the highlights: in the UK, the HomeServe and TSB relationship's gone well. And in Canada, the acquisition of Royal Bank of Canada's insurance operation has been fully integrated. And I must say the results out of that business after the first few months have been higher than our business cases would have predicted. So that's been a highly encouraging start indeed. And you know what? In general insurance, there's much more to come. Our health insurance business, you know, I think that's a hidden gem. Its operating profit was up 19%. And I think there's still more to do there, and I have high expectations. The international businesses, well, they were mixed. Europe was resilient in a pretty challenging market, but it's fair to say there's still more to do in our European operations. Asia's purely a disruption strategy, and I believe the Asian business models in the market are aging, it's ripe for disruption, and I think we're the company to do it. And we have some pretty high hopes there. Another highlight in Asia was the deal with Tencent and Hill House. That's a disruptive digital insurance strategy. And you know what? In a market that's maturing like Asia is, I think that is the future. And what about life insurance? It's an important business. It is our biggest business. What you saw again was another year of consistent, solid growth. Operating profit up 8%. Value of new business up 13% despite the challenging markets. And in terms of the UK life business, they delivered all of the Friends savings, the Friends integration cost savings, 1 year early. So that was a pretty good result. What we've seen in the life businesses, particularly in the UK, is resilience because we have a full range of products. And I think of Aviva in terms of this business has continued to buck the Brexit blues. And where one product was a bit slow, like bulk annuities, other products like some of the investment products and the fund management products and the protection products, they showed some really good solid growth. And again, it's that resilience we want to see throughout our businesses. Asset management. It's really been a breakout year for asset management. After a few tough years in restructuring and getting the hero products out there, that business has delivered some really solid inflows. In fact, some of the best in the market. The AIMS product, that tripled from 3 billion funds under management to 9 billion funds under management, and I believe continues to lead the market. We've got a great team in place. It's now 5% of our operating earnings and growing, and it really is becoming a core part of our operation. I've set out the vision that Aviva wants to be a 320-year-old disruptor. We want to be a digital insurance disruptor. And you know what? I think we're the most advanced out there. We've managed to get all of our customer systems talking to each other, and that's quite a feat for any large insurance company. We've doubled the customer registrations on our major portal, MyAviva, up to 5 million customers, and the customers using it have a satisfaction score of 75%. We've got our digital garages in Hoxton and Toronto and Singapore. We have the regulators working with us to make sure the regulations are right and appropriate for digital. And make no mistake, digital and Aviva, I think both of those are the future. You know, a few years ago I set out our vision, our promise to investors about cash flow and growth. And I think it's pretty clear now we are delivering on both of those. But it's not enough just to deliver in 1 or 2 years. We need to deliver year after year after year. And I think our franchises are well positioned to do that. We've delivered this year, I think, a great set of numbers. More profit, more growth, more cash, more capital. And we've been very clear today on the strength of our balance sheet. The fact that we're now planning to give some capital back to shareholders and pay down debt, I think really underlines the strength of our balance sheet. But you know, not all in the garden is rosy, and I think there's still much, much more to do. I think as a business, we're not as efficient as I'd like us to be in all areas. Not all of our countries are going well. You know, we've broken our countries into oaks, acorns, and apple trees, and we've still got some work to do on the apple trees, and we've said that we're going to withdraw some capital from some of our businesses and reallocate it to others. So what can investors expect? Well, I've set out a target that we're going to grow operating profit by mid-single digits. I think our results in 2016 in a challenging year prove that we can do that. We've also said we're going to get 7 billion in remittances from the businesses back to the group. I think our results this year with a 20% increase in remittances also show we can do that. And then we've also said that we're going to get a 50% payout ratio on dividend. I think that just shows once again, all we're doing is doing what we said we would. And that's the Aviva I want to see.